What if you could buy a stock before the market even opens and have an 85% chance of being right? That's not a sales pitch. That's what the data showed. But to get there, I had to backtest 53 stocks across 60 days of historical data, throw out 31 of them, and discover that some of the most obvious choices, SPY, Tesla, Nvidia, were actually the worst ones. This is how I built the pre-market gap strategy for my AI trading bot, and I'm going to show you the real numbers, including the stocks that completely failed. Quick background. The U.S. stock market opens at 9:30 a.m. Eastern, but stocks actually start trading as early as 4 a.m. in what's called the pre-market session. Here's what a gap looks like. A stock closes at $100 on Monday. Overnight, the company reports strong earnings. By 7 a.m. Tuesday, the stock is already trading at $103, before a single regular session share has changed hands. That 3% difference is the gap. The question every trader is trying to answer is simple. Does that gap keep going, or does it snap back? If the stock keeps climbing after the open, that's gap continuation. If it reverses and falls back toward the previous close, that's a gap fade. And the brutal truth is that most gaps fade. Most traders buying pre-market gaps are on the wrong side of the trade, so before I added this strategy to my bot, I needed to know exactly which stocks actually continue after a gap, and which ones trap you. My first instinct was the obvious one. Buy any stock that's up at least 2% before the open. Cast a wide net, catch the big movers, profit. I coded it up. I backtested it. And it was negative. Not slightly negative, meaningfully negative across 60 days of data. The gaps were fading. I was buying at the peak of the pre-market move and watching the stocks sell off through the morning session. My stop losses were getting hit consistently while the target sat untouched. I had two choices: abandon the strategy or understand why it wasn't working and fix it. The core problem was that I was treating all gaps the same way, and they are not the same thing at all. Think about what causes a gap. A pharmaceutical company announces FDA approval at midnight. A tech company beats earnings by 30 cents. The Fed makes an unexpected rate comment. An airline stock gaps up because two countries reach a ceasefire. In each case, the gap is real. But what happens next depends entirely on the type of stock. Large, stable companies, your SPYs, your Apples, your Nvidias, tend to gap up and then immediately face selling pressure. Big institutional traders use the pre-market spike to exit positions at better prices. Retail buyers rush in, institutions rush out. The gap fades. High beta stocks are different. Leveraged ETFs, crypto-adjacent names, high momentum plays. When these gap up, the momentum traders pile in and push them further. There's less institutional overhead selling. The gap continues. This explained everything. What I actually needed was a list of specifically which stocks have a proven history of continuing after a gap, which meant I had to test them one by one. I built a script called Gap Universe Scanner. It takes a list of stocks, pulls 60 days of historical price data, and simulates every gap-up event that hit a specific threshold. For each signal, it calculates whether the stock continued upward or faded, what the outcome was using my exact trade rules: entry at the gap price, stop at -2%, target at +4%, and it tracks the win rate and total profit and loss across every signal that fired. I started with 53 stocks, everything from S&P 500 heavyweights to leveraged ETFs to crypto-adjacent names. I wanted a broad enough sample that the results would mean something. One important detail: I tested a 2% threshold and a 3% threshold separately. The 2% threshold was negative across almost every stock. Adding that extra percentage point filtered out the weak, noise-driven gaps and kept only the genuine momentum moves. From that point on, 3% was the minimum. Here's what the data showed. TQQQ, the 3X leveraged NASDAQ ETF, had a win rate of 85.7% on gap-ups over 3%. 7 signals over 60 days, 6 winners. Every time the NASDAQ gapped up hard before the open, the momentum carried through. AMD came in at 80% with 10 signals and over $21 of profit on a $35 position size. Teckle, the 3X semiconductor ETF, hit 71% with 14 signals. Bulls, another leveraged tech ETF, at 66% on 12 signals. What these stocks have in common: they move with leverage. They attract momentum traders, and when they gap, the buyers who caused the gap are still in buying mode when the market opens. The position sizes are small on purpose. This bot trades with roughly $1,000 in capital. These aren't life-changing numbers. What they are is a real positive edge that compounds over time. Now here's the part most trading YouTubers skip. SPY, the most traded ETF in the world, had a 44% win rate on gap-ups. Negative P&L over 60 days, completely removed from the strategy. Tesla, 45% win rate, negative, removed. Apple, 40%, negative, removed. The standard QQQ, 47%, barely better than a coin flip, and negative after costs, removed. And then there was Cast, 0% win rate. Every single gap-up signal on Cast over 60 days resulted in a loss. It wasn't close. Cast is now permanently banned from every scanner in the bot, pre-market, scalp, and overnight. The data was that clear. The lesson isn't that these are bad stocks. It's that gap-up continuation is not a property of being a good company. It's a property of how a stock moves and who trades it. SPY failing while TQQQ succeeds is counterintuitive, but the data doesn't care what you expect. 22 stocks made the cut. I call it the Gap Whitelist. It lives in a file called gapwhitelist.json, and it's the only universe the pre-market scanner is allowed to trade from. It doesn't matter if 300 other stocks are gapping up on a given morning. If they're not on this list, the bot ignores them completely. The whitelist isn't static. Every Sunday at 6 a.m., the bot automatically reruns the backtest against the most recent 60 days of data and rebuilds the list. If a stock's edge degrades, maybe its behavior changed, maybe the market regime shifted, it falls off automatically. No manual intervention required. This is probably the most important design decision in the whole strategy. A fixed list from 6 months ago would eventually stop working. A list that updates itself stays calibrated to current market conditions. One thing that caught me off guard when I first built this: Robinhood has specific rules for pre-market orders. You cannot place a market order before 9:30 a.m. Pre-market requires a limit order with a specific price, so the bot places a limit order at the current pre-market price plus 0.3%. Just enough of a buffer to ensure the order actually fills without chasing the price. The time in force is set to GFD, good for day. If the order doesn't fill before market open, it expires. The bot doesn't carry failed pre-market orders into the regular session. And immediately after a fill is confirmed, not a few minutes later, immediately, the bot places a GTC stop-loss order at -2%. The protection goes on before anything else happens. That's non-negotiable. June 23rd, 6:21 in the morning. My phone buzzes with a notification. Not a phase-complete message. An actual trade notification. ORB entry. BLZE long at $11.89. Stop at $11.65. Target $12.37. This was the first real autonomous trade after fixing the bug I talked about in episode 2. The bot had been silent for 21 days. This was the morning it finally worked. BLZE was on the watch list from the night before. The after-hours scanner had flagged it moving after hours. The pre-market scanner caught it still running strong at 5 a.m., confirmed the gap, placed the limit order, got filled, and immediately placed the stop. 22 minutes later, the target was hit, plus 4%. $1.68 on a $35 position. That's not a retirement fund, but it's proof the system works end-to-end. Detection, entry, protection, exit, without me touching anything. I want to be straight with you about where things actually stand. The bot has been fully operational for a matter of days. The backtested numbers are real historical data. The live results so far are a handful of trades, not a statistically meaningful sample. What I can tell you is that the architecture is sound, the edge is real on paper, and the execution is working. Whether that translates to consistent monthly profit is something I'm going to show you in real time every week, including the losses. There is no version of this where I cherry-pick the wins and hide the losses. That's not what this channel is. You'll see the full P&L, the good runs, the rough weeks, the trades that stopped out, all of it. Next episode, I'm going to walk through what happens when the bot takes a loss. Specifically, how the stop-loss system works under pressure, what the daily loss limit does, and the day the bot hit 2 stops in a row and automatically paused itself. If you're building something like this, or you just want to watch someone figure it out in real time, subscribe. New video every week, real trades, real code, real results. And if you want to try Robinhood yourself, there's a link in the description. It's an affiliate link, which means I get a small commission at no cost to you. Same with 11 Labs, which is the AI voice you're hearing right now. Both links are down below. I'll see you next week.